Josh, I go to you first. Just sort of give me your thoughts about where we are, how you're feeling about things today.
Well, so I would say that obviously stocks are well off the lows, but people are saying, is this the bottom? Was that the bottom? I'm not sure that's the right way to be thinking about the market overall, but it is encouraging to see the XLF, the bank stocks, 11% off their morning lows. I think that's 100% due to the actions that central banks around the world have taken. Forget about the overall level of rates. Dollar swaps are very, very important right now. People that are bringing collateral to the window should know that they can continue to do so for as long as they need to do so. As of this morning, I was looking at Disney and JP Morgan Judge. I own both stocks. Each of them were 40% off their highs at those lows, recovering somewhat. The S&P 500 at its morning low was 30% down from peak to trough. The Russell 2000, 37% down. Needless to say, in a short period of time, that's a huge decline. That's a huge decline in any period of time. But in this period of time, that is absolutely historic. Transport's 38% off peak to trough, and the semis down 32% off their highs. So now if you're saying to yourself, well, do the fundamentals justify seeing all of these major averages 30% off their highs? My message to you is that markets will way overshoot whatever you think the fundamentals should dictate. So we should not be looking at things like PE ratios or next month's or the following month's same store sale. None of those things are going to matter right now. You have this combination of two things. First, people that haven't panicked yet, now is their chance, and they're panicking even more so. And second, there are mechanical things happening in the market, like value at risk calculations, that have major pools of capital literally being forced to sell. There are strategies that react based on volatility, and they sell even more. Right. So I think what the Fed did, they're not going to forestall a recession, but I think they've created the conditions that will allow that forced selling to take place for as long as it needs to, and that's a positive.
Joe, Josh lays out an interesting perspective, and that's you look at some of the stocks and these marquee names that have come down so far and come down so fast, and one side of you says it's been overdone. The other side says, as Josh did, it doesn't matter because they may go down even further. It's the realization setting in that nobody really knows where all of this is going to settle out.
I would agree with Josh's comment. Right now, it's not a matter of where is the bottom. You're not trying to find that. Right now, assets are pricing at a level that's telling you you're going to have to assume much more risk than you've had to assume in the last 10 years. And for the assumption of that risk, Scott, the expectation is that somewhere in this process, you will be rewarded for taking on more
Joe,
of that risk.
I'm gonna have you redial in. Your phone line's shaky a little bit. I just want to see if we can do a little bit better than that. Bear with us, all of you. Please bear with us today. Steve Weiss, you want to chime in on sort of what you're thinking about? You heard Josh's point. Just give us your thoughts. Yeah. You've seen a lot of these markets. I know you're trying to figure things out on your own right now.
Yeah. So, look, my target had been, without any firm conviction, down 30% on the market. We've hit that down 30% from the highs, but I believe it will now be greater. To me, this is worse than 08, and I've lived through 2002. I've lived through 2000, through 98, through 87. And this is different. And the reason why it's different is that in those environments, you can say this is the problem, this is how we attack it, and this is how we cure it. Here, and the problem was generally, if you go to 08, it was too much leverage in the system, too much leverage, primarily financial institutions, consumers, and then, of course, the auto companies and some others. Here, the issue is not that. The issue is that there's no demand out there as everybody hunkers down at home or in their office, if they can go to the office, like I'm in my office because I'm out in New Jersey, and you're not sitting there saying, here's what it's going to take for me to go back into the world of commerce. You're not. So in an economy that's 60 to 70% consumer-driven, there's no cure for that except for time. So there's no monetary stimulus that's going to get me to go out and re-engage with everybody or anybody else. And fiscal stimulus at this point in what we're dealing with the virus is also unlikely to do anything. It'll give you some comfort that things may not get disastrous, but not to get you to go by. So I think you have time. And Josh is right. Throw out fundamentals, but you should also throw out where stocks were before. So it makes no difference where J.P. Morgan was, where Disney was. That's a frame of reference that just doesn't matter because we don't know how long this will take. And in fact, whether we get back to that in a year, 2 years, or 3 years.